or planning for tomorrow so you can live today. Your business is personal. Your advice should be private.
Successful global compliance is demanding. How do you make sure you get the job done? File accurately, on time, in every country, and across every process? How do you gain control, visibility, transparency, and governance globally and at a local filing level? How do you reduce costs and risks? How do you free up your team's valuable time? How do you look to the future, explore the latest technology, tackle new regulations, and plan ahead? How do you leverage the power of your data to deliver real commercial value? At Deloitte, we aim to make your life easier and help you deliver your global compliance successfully. We can also help you to articulate and demonstrate real business value to your stakeholders. We do this in 5 simple steps. We help you get it done by bringing the wealth of Deloitte's global experience. From our deep in-country experience to provide market insight, through to our regional delivery centers, to our centralized coordination teams that support governance globally and control locally. Our MyInsight platform integrates visibility into your data collection and processing activities with a seamless process. Deloitte can cleanse, map, and classify your data and make it visible to you through a single hub. Data can then be consolidated, reconciled, and reported, including any required local tax regulatory requirements. Reports can be produced for your statute and business needs. We will be your eyes and ears globally to assist you to understand local changes so that you can gain control of your compliance. By enhancing your compliance management, you can look to reduce the overall cost of delivery and risk. This will free up your people so that they can add more value and help grow your business, meaning you can get more from less. Deloitte's global experience means we are at the forefront when it comes to resource planning, regulatory change, and digital readiness. This, coupled with our innovation labs and market know-how, means we're best placed to work with you and guide you on this journey. We have the experience to help you make practical plans for what we know is coming and to scenario plan for what might be. All of this combined with setting out achievable actions will help you put your best foot forward as you face the future. We help you discover value to find commercial return for your business and free up your talented workforce to keep them challenged and engaged. Get it done. Gain control. More from less. Face the future. Discover value. Deliver confidence. Successful global compliance can be demanding, but Deloitte makes it easier and helps you see beyond.
Significant global regulatory change combined with rising demands for tax transparency have left some of the most seasoned transfer pricing leaders feeling overburdened and uncertain. How will the BEPS actions be implemented in each country? Does our transfer pricing model
Good morning and welcome to everyone joining us virtually this morning. Welcome to Deloitte's 2022 Tax Outlook, digesting tax changes in the landscape in Ghana. It's a pleasure to have you this morning, and we would be more than happy to take you through some of the key changes that we have seen in the past year coming into this year, 2022, and some of the key risk areas that you should be aware of. By way of housekeeping rules, please note that this is a webinar mode Zoom setting. You have the chance to ask questions in the chat box. Please feel free to put in your questions in the chat box as we go along. At the end of the session, we would also have a Q&A session where you would have the chance to either ask your questions via the chat box or raise your hand, and we would be more than happy to unmute you so that you can ask live in-person questions. This webinar would be recorded and afterwards would be made available to participants and those who are not able to join us live today. A summarized version of the slides that we will be presenting would also be shared with you. So thank you for joining this morning, and welcome again to Deloitte's 2022 Tax Outlook. By way of introduction, I am Wisdom Kwame Pano, a senior manager with the Tax and Regulatory Business Group here in Deloitte. I will be your host and anchor for this morning's session, and we are looking to work within 1.5 hours as we advertised. We have George Ankuma, our lead tax partner here in Deloitte, Ghana, as a panel member who will be sharing insights and experiences from dealing with the tax authority, dealing on various client engagements and consulting issues. We also have Eric Osei-Poku, a manager with our transfer pricing business group, would be giving insights from a transfer pricing point of view. And as you would see, a lot of changes expected this year from a transfer pricing point of view. What should you keep on your calendar? What dates should you keep and not miss? And what documentation would you be filing this year with the Ghana Revenue Authority? Last but not least, we also have our Lovejoy Autry, who is a manager from our Global Employer Services Group. She specializes in employee income tax compliance and global mobility advisory. Lovejoy will also be giving us insights on, from a personal income tax perspective, risks we should be aware of and what we should be doing by way of documentation to support positions that are taken so far as they are in line with the law. Without much ado, I would want to show the content for today, the agenda for today. Over the next 1.5 hours, we are looking to look at the key tax and regulatory changes that have come by, mainly from the budget reading, amendments that have followed, and other changes that you should be aware of. We would also be looking at changes to expect in 2022. Some of these changes have not yet been passed into law, but what are we picking from our discussions in the market, from our engagements in the industry? Then we would also be looking at some key risk areas to consider in 2022 and beyond. And we would also have a session where we look at your 2022 tax compliance calendar, which you should have on hand throughout the year and be able to keep to dates and deadlines during this year. So definitely, as I mentioned, we are planning to have a good part of the program where you also interact with us. So in the last 20 to 30 minutes of this webinar, you would have the opportunity to ask questions, but please feel free to use the chat box even as we go through the session. We are looking to have it as an interactive session. Use the chat box as we go on, and we will be more than happy to address your questions. Without taking much time, let me use the first session to look at the key changes that have come by way of tax amendments in 2022. Now we have the personal income tax band being revised in 2022. This ban is effective from 1st January 2022. So we'll have to take note. The last time we had a change was in 2019. We did not have a change in 2020, but then for 2022, the first tax-free amount, chargeable income, has been revised to 4,380 by way of the annual chargeable income. And we also have 365 by way of monthly chargeable income. This is changing from 319 as we had in the prior period, and 3,828 for the annual chargeable income we had in the prior period. The rates remain the same. You have the top marginal rates being 240,000 Ghana cedis as the top marginal threshold, beyond which you would have a tax rate of 30%. And then on a monthly basis, we have that as 20,000 chargeable income with a tax rate of 30%. So it's important that your payroll filing for the month of January and beyond takes into consideration this new change, which is expected to yield some marginal increase in the take-home pay for employees. So this is important that we take note, and take notes also that the effective date is 1st January 2022. We also have a revision to the presumptive tax regime. This is under the second schedule of the Income Tax Act, and this presumptive tax is an informal taxation regime that has been put together for individuals other than individuals in certain categories. So individuals in business who do not have more than one place of business, who do not have a professional certification and other criteria, can come under this presumptive tax, where there's a tax of 3% on turnover. So previously, you needed to be within the range of 20,000 by way of revenue to 120,000 Ghana cedis. This has now been revised to 200,000 to 500,000. So for individuals who are not in the excluded categories, having revenue or business revenue between 200,000 Ghana cedis and 500,000 Ghana cedis, can elect for this presumptive taxation on turnover. And this would represent the taxation, is that it's much simple to apply. It's a modified taxation, so it's accounted for on a modified cash basis. So if you are running a business and you fall within this threshold of 200,000 to 500,000, you want to check out this change, and also want to check out the second schedule of Act 896, which is the Income Tax Act, to see whether you qualify. And this would be a simple way you meet your obligation by way of business tax obligation. Now we also go on to another very important amendment to the Interest and Penalty Waiver Act that was passed in 2021, and the concept or government policy direction was to give some form of support to businesses as businesses recover from the COVID-19 pandemic. Now, this act allowed for waiver of interest and penalties for years up to 31st December 2020, but the application should have been filed by the end of September 2021, and payments or arrangement to make payments to be made by 31st December 2021. I know individuals and businesses, taxpayers on this call may have applied, but government, from feedback from the general public, the investing public, and taxpayers, has decided to extend this application or window for extension, which I more simply want to refer to it as tax amnesty window, to June this year. So still up to June 2022, businesses, taxpayers have the opportunity to apply for amnesty and make payments by that date. So this is critical because opportunities may come, but they do not often come twice in a row. So this is critical. If you're a business and you have not yet assessed your tax, assess your tax rates for the past years up to December 2022, to December 2020, sorry, this is again an opportunity to do that assessment and see whether you have some tax exposures, and apply before or by 30th June 2020. The sweetness in this amnesty is that you get a waiver from interest that would have otherwise been imposed on the liability if it was discovered in a tax audit. The good news again is that almost everyone and every business I know that applied for the 30th September 30th September 2020 window is getting approval. So it's real, and this is still an opportunity to take advantage of tax amnesty extended to June 2022 this year. Again, there are some other changes that you may want to be aware of. We have a change on the withholding tax rate on payment for unprocessed gold. Payment for unprocessed gold. So it used to be 3%, but this year the Amendment Act to the Income Tax Act has changed this rate and reduced it to 1.5%. 1.5% to mitigate the idea or the window for smuggling, and to ensure that governments at least gets the maximum revenue possible from sales out of unprocessed gold coming out of our small scale mining industry. So the reduction 3% used to be 3%, it's now come to 1.5%, which is quite good for players in this industry, and hopefully it encourages small scale miners and sellers of unprocessed gold to come within the formal sector, or to come within the tax net to be taxed accordingly. Now, we also have an extension of VAT zero rating on locally manufactured textiles. Now, this policy was intended to support the local textile industry, which has suffered for some years now. The initial policy was to expire at the end of December last year, 2021. But then the government has extended this VAT zero rating to 31st December 2023, which means a 2-year extension to continue to support locally manufactured textiles. So supplies from local manufacturers of textiles would be at zero rate. It means that the manufacturers will be able to claim inputs, VAT, and of course claim refund on VAT credits that they are likely to have from their inputs. So again, welcome news for the textiles industry, extension of zero rating, VAT zero rating to 31st December 2023. So that's an important development for the textiles industry, and I've personally had clients in this industry that have benefited from this policy. So we can only look forward to this extension helping our ailing local manufacturing, textile manufacturing industry to get back on its feet and to contribute its quota to the GDP of the country. We also have a directive that came in last year. So this is not a law on its own, but this is a directive that the Commissioner General of the GRA issued to its staff somewhere October 2021 to take effect from October 2021. The crux of this directive essentially is to officers to review invoice claims for CIT purposes, for corporate tax purposes, and make sure that expenditures that exceed 2,000 Ghana cedis are supported by tax invoices or VAT invoices, if we want to call it in the normal sense of things. So if it's your expenditure relates to a taxable supply, then you are obliged to show a VAT invoice to support the claim, even from a corporate income tax perspective. This remains a directive. We are aware the directive generated a lot of public discourse and in some quarters, some pushback because there are policy implications of this. But this remains a directive within the Ghana Revenue Authority. It's important as you understand how you put your house together for 2022 and beyond. It's important that you are aware of this directive and you plan your documentation, your dealings in that manner. If you are dealing or purchasing taxable supplies you know are taxable supplies that are not listed under the first schedule, such as on processed agricultural products, drinking water, other than that in a bottle, raw fish and all that. You are purchasing your services, stationery, and other expenditure lines related to the business and that are ordinarily taxable. You should be sure that you are aware of this directive. Where possible, you deal with VAT registered vendors to be sure that you are dealing in a formal way and getting your VAT invoices. Insist on getting your VAT invoice. Insist on getting your system generated invoices. So what the whole directive means is that even where you have an audit from a corporate income tax perspective, you would have to also show beyond your ledger breakdown of expenditure, you would also have to show that the invoices are VAT invoices. And if they are not VAT invoices, you have the commissioner's approval for the supplier to issue system generated invoices. So that is critical. And the directive, as I mentioned, generated a lot of discourse. Until there is a change, it's important that your filing, your documentation meets these requirements to be in a good position when it comes to tax audit and to support your claims from a corporate tax point of view. We also have a change relating to VAT, a very widespread and a very important change relating to VAT flat rate scheme. Now, before the Value Added Tax Amendment Act of 2021, Act 1072, the regime we had was retailers and wholesalers of goods in Ghana were under the flat rate scheme, where they charge 3% plus the recently added 1% COVID levy, so a total of 4% flat. Now, this change means that for retailers who have taxable supplies between 200,000 and 500,000 on an annual basis, or expect to make taxable supply between 200,000 Ghana cedis up to 500,000 Ghana cedis, would have to would continue to be under the flat rate scheme, but retailers beyond 500,000 taxable supplies and all wholesalers now move to the standard scheme under VAT. So it's important, again, the Ghana Revenue Authority has issued clarification that is clear that the implication or the application of this revision starts from 1st January 2022. Unfortunately, the law did not come out early. The Ghana Revenue Authority notice came only in on 21st of January 2022. But then the effective date is still 1st January 2022. So it's important that if you need to have recalibration of your system, transitioning from flat rate to the standard rate, that has to be done quickly, if not already done, and take steps to mitigate exposure to undercharging VAT on your supplies. So flat rate scheme is now for retailers who meet the registration threshold, which is 200,000. So that is a given. Retailers below 200,000 do not meet VAT registration threshold and are not within the scope of VAT. So if you are within 200,000 Ghana cedis by way of taxable supply, up to 500,000 Ghana cedis taxable supplies, you remain within the flat rate scheme, 3% plus 1% COVID levy. If you are outside, if you are more than 500,000, even as a retailer, 500,000 annual taxable supply, you then fall into the standard scheme where you charge 12.5% plus a total of 6% by way of levies. And all wholesalers of goods also moved to the standard VAT scheme. So this is a very critical change that if you have not taken note of this already, it's important that you do take note of this. Another change that came late in 2020 continues to apply up to 2023 is the class ruling to the members of the Ghana Association of Bankers. Essentially, clothing allowance, there's been a ruling on clothing allowance, which allows 20% of clothing allowance, but not exceeding 5% of basic salary to be allowed as reimbursement of expenses and therefore not taxable. Amounts beyond this threshold would be subject to tax in the hands of workers within the Ghana Association of Bankers or banks that belong to this association. It's important to note that the ruling applies up to December 2023. So not a change for 2022, but this came in December 2020 and continues to apply with a sunset clause of 2023, beyond which all allowances are likely to be fully taxable in the hands of employees within banks that belong to this association. So another important reminder for tax managers, finance managers, accountants within the banks in Ghana that belong to the Ghana Association of Bankers. We now have another very important change coming up from a regulation that came in 2020, and it's important from a transfer pricing point of view. I'll call on Eric to give some highlights on what to expect in 2022 by way of transfer pricing compliance. Eric, over to you if you can hear me.
Thank you very much, Wisdom, and good morning to everybody. So the transfer pricing landscape in Ghana has changed over the years, and with the introduction of the new transfer price regulation that was passed in 2020 November, we have had additional compliance requirements coming up. In the past, we were required to file transfer pricing returns 4 months after the financial year end with the Revenue Authority, and it was to disclose related party transactions that are taking place during the year. But a new regulation has brought additional filing requirements as indicated within the 3-tier filing under the BEPS Action 13 plan as the OECD had pushed for, and it's introduced local file filing, master file filing, and then country by country report filing. Now, the local file filing and master file filing are supposed to be filed along with the transfer pricing return, which would mean that 4 months after your financial year end, you are required to file a transfer pricing return, as was done in the past. A local file that, as was prepared in the past, but was not submitted to the Revenue Authority, and then a master file. And then 12 months after your financial year, you're looking to file a country by country notification to the Revenue Authority and a country by country report. Now, these arrangements are supposed to be done electronically, and the Revenue Authority currently has updated its portal to allow for filing of the transfer pricing returns that had existed as of last year, but also has included the local file filing and the master file filing requirements on their portal. The modalities around the filing and other aspects of the new regulation are yet to be passed as part of the practice notes, but we are still earnestly waiting for the Revenue Authority to come through with that. And once those documents do come through, we surely would bring up taxpayers up to date on it. So I think that's in a nutshell the update on transfer pricing requirements. Wisdom, thank you. Okay, so I think whilst we move on to the next stage, Wisdom, please go ahead.
Yeah, right. So I would want to take some questions. So thank you. It looks like it's going to be a busy year for transfer pricing. We will have to deep dive into that when we come to what to still expect, the risk areas, and also the calendar for the year 2022. So there are some questions that we would want to quickly take before we go on. I see, so from Prince, what will be the position of that directive if I buy from someone who does not meet the requirement for VAT registration? So yes, a very valid question. And this, I believe Prince is referring to the directive of keeping VAT invoices for every purchase above 2,000. This is one of the key areas that has led to a lot of discussion around the directive. One, the 2,000 is arbitrary at best, so there's no science, in my view, behind how we determine the 2,000. And again, as you've rightly said, there are genuine formal businesses that do not meet the VAT registration requirement of 200,000 taxable supplies in a year. So if you are buying from someone in that category, then it's important that you maintain you maintain some form of documentation for the purchase. So it's an important position, but then what I would recommend is that in your documentation and then in your filing, you clearly indicate why you do not have VAT invoice. You indicate that this is, for instance, from a small shop in your vicinity, and the person reasonably does not meet the registration requirements. Again, this directive should continue to be a subject of discussion, the threshold, and what is the direction, whether there's any consideration for small, genuine, small businesses that should also be encouraged to run their business. Elvis Calvin Owusu is asking timelines for transition. So the Ghana Revenue Authority has published on its website and also published a notice through the graphic, 21st January, and the notice is clear that implementation should start from 1st January 2022. So direct answer to your question, yes, you would have to start charging or transitioning to the standard VAT scheme if you now qualify under standard. We are hoping some guidelines will come out around what the mitigation plan for exposures that businesses would have genuinely suffered by now. Slides will be provided. I mentioned that the summarized version of the slides will be provided after the presentation. So thank you, Kevin, for asking. Kevin also asked about the GSE, realization of gains on GSE. So we will come to that. So it's not been made, the exemption has not been made permanent. So we'll come to why it's not been made permanent and what the new position is now. Closing stock as on 31st December 2021, VAT input allowed. Okay, so if you have closing stock, VAT is on accrual basis. So my expectation is that if you have invoice, for instance, in November, you would have already accounted for the VAT in the November, December. The flat rate scheme holders did not have the opportunity to claim VAT. When we had a similar transition, closing stock, VAT on closing stock was allowed. We would want to see what guidelines the GRA will come with. But again, remember that if you've already expensed this in 2021, that goes into your cost deduction, then you will not be allowed input claim. So the GRA has not come out with guideline, but what could reasonably happen would be that you would have to claim the input or the cost of the input VAT via your corporate income tax calculation. That is what is likely to happen in the absence of any guideline on that in that line. So someone is asking about reporting on transfer pricing. Yeah, transfer pricing applies to entities that have related party transactions. So if it's an entity with no related party transaction, then there is no scope for transfer pricing for you. We would want to go on with the changes. Please keep your questions coming. Again, we'll take some time to address your questions, and also we'll have a Q&A session at the end. All right. So there are still other changes in the regulatory landscape that we should be aware of. The Ghana Revenue Authority, for instance, is asking everyone to merge their thing or transition to NIA numbers from 1st April 2022. So our existing thing, tax identification number for individual taxpayers, are to be merged with the Ghana card, and by 1st April 2022, the Ghana Revenue Authority would only recognize the code or the exclusive identification number on your Ghana card. This, of course, does not cover foreign mission employees, non-resident foreigners who do not meet the requirements for Ghana card, as well as non-resident cards. So this is something that we have to take note. And the Social Security and National Insurance Trust is also asking for a similar measure. The deadline has now been extended to 30th June 2022. So from 1st July 2022, the Ghana card, the personal identification number on the Ghana card would be your SNIT number as well. So this is something that we should take note for employees and for persons that are in human resource roles, payroll roles, CFOs, tax managers. It's important that we are sensitizing our employees to do this measure update so that you do not have any issues with filing when the time comes and the GRA and Social Security starts implementing these directives. We also want to touch on gains on disposal of securities that are listed on the Ghana Stock Exchange. So traditionally, we've had these gains exempted by way of legislation to exempt any gain realized on disposal of securities listed on the Ghana Stock Exchange. And this policy was intended to encourage listing on the stock exchange and also participation in securities on the stock exchange. The latest extension ended 31st December 2021. Now, there was expectation based on the 2021 budget reading for this exemption to be extended or to be made permanent. However, we are seeing that from amendments in 2022, there has been no extension, and it appears that government policy in this regard is changing and has indeed changed. So from 1st January 2022, disposal of securities on the listed on the Ghana Stock Exchange would be subject to tax. So if you make a gain from such a disposal as an individual, as an entity, as a non-resident, you would be required to pay a tax at the appropriate rate on such gain. So this is an important development. It's not very conspicuous because there's no written change. The current law that provided extension had its own sunset clause of 31st December 2021. So once 31st December expires and there's no extension, automatically taxation kicks in. So this is important for players in the investment space to take note of this. I know businesses also may have some investments listed on the stock exchange. So this is important to take note of for the year 2022. I will see if there are still some questions that we can take before we go to what you can still expect in 2022. I know some of you may have raised your hand. Please allow us to call you when we start the Q&A session, which will be in some 20 to 30 minutes from now. Okay, so Collins Mensah asked, please can you touch on the reviewed VAT flat rates again? All right, so with the VAT flat rates, and it's important to know where we are coming from, the recent past, VAT flat rates was for all retailers and wholesalers of goods. So if you are a VAT supplier in Ghana and you are retailing goods that are not exempt goods but taxable goods, you have to apply 3% plus 1% COVID levy flat rates. You do not have the opportunity to deduct any input VAT on your 2022 VAT Amendment Act is making this revision, said that those who would charge the flat rate would be retailers, one, plus such retailers that fall within this annual threshold of 200,000 Ghana cedis and 500,000 Ghana cedis. So if your taxable supplies are between 200,000 and 500,000, then you are a flat rate scheme supplier. You remain there and you charge 3% plus 1%, no opportunity to claim input VAT. You charge on your taxable value and pay the VAT and levy to the Ghana Revenue Authority. The change is that now retailers that are large and have taxable supplies exceeding 500,000 per year. So if you expect that your taxable supply over a 12-month period would exceed 500,000 Ghana cedis, you now move to the standard rate scheme. Again, all wholesalers, regardless of how much you make in a 12-month period, move to the standard rate scheme. So all wholesalers and retailers that are above 500,000 taxable supply threshold for a year now join everyone else in the standard rate scheme. Standard rate scheme means that you charge a total of 6% on your taxable supply. If it's 100, you charge 6 on the 100 to become 106. That becomes your VAT base. Then you charge 12.5% on 106. You have the opportunity again to claim inputs on all VAT that you pay to your own suppliers. So that is the change, and I hope it makes it clear. So from Derek, I want to ask if you issue a requisition to buy vegetables from a local market for restaurant operations. Can you use the requisition for filing for standard VAT? Right. So first of all, I would expect that the vegetable would be exempt. So vegetable in its raw state would be exempt from VAT. But then if you are talking about any input claim, one, you can only claim an input if you have VAT invoice. So automatically, if you do not buy a taxable supply, you do not get a VAT invoice. Hope that clarifies. Is it any norm on how to fix this transfer pricing intercompany? So I'm sure you are asking about fixing transfer pricing intercompany. So Eric, you may I suspect the question is around how to go about fixing the prices for intercompany transactions.
Yeah, thank you, Wisdom. So the regulation provides that low value added services cost plus markup up to 3% for low value added services. We also gave net up to 2% of net profit for royalties, know-how, and technical management services. Those are the safe harbors that are provided in our regulations. Any other pricing that you'd want to do, you need to actually do a benchmark analysis to ascertain that the pricing that you have chosen falls within the arm's length range, or should I say the interquartile range for purposes for discussion. So a benchmark analysis would be used to determine the pricing for which intercompany transactions should be undertaken. And that's what the regulation has provided for.
Great. Thank you, Eric. I believe, again, when we get to the key risks, we can see some more. We've done a lot by way of changes that have come. What are some of the changes that may still come? The almighty electronic transfer levy, electronic transaction, or e-levy, as it's now popularly known, is still likely to come by. As you may be aware, discussions continue within Parliament and within the Ministry of Finance to have this act implemented. So in 2022, we are expecting e-levy acts in some form at the minimum. Exemptions bill has also been talked about a lot. This is a bill that is to code the practice around exemptions and how exemptions are granted. We expect that the bill will go through Parliament and likely to be passed this year. We also have intensified revenue assurance and compliance activities. So the finance minister mentioned that the race unit of the Ghana Revenue Authority will intensify its activities. What does that mean to you? What it means is that with a higher tax revenue target for 2022, we are likely to have intensified tax audits. So it means that you should be expecting more tax audits in 2022 and beyond, and you should be putting your house in order. Tax audits can go well from because you get assessment of your tax status and you close out years. But it's important that you prepare appropriately for said tax audits. And we are also going to see implementation of the proposed unified common platform for property rate administration. Again, this is out of the budget that a platform is to be put together where the GRA would assist the MMDAs with property rate compliance. So if you're a property owner, it's likely you should be having the GRAs at your doors, so you prepare accordingly. Review of fees and charges out of the various government agencies. It's likely to still be implemented as announced by the budget. And also finality on the benchmark value policy. This is still in discussion. So the government intended to reverse its policy to grant discounts on benchmark values. We had 50% discount on general goods, 30% on vehicles. Earlier in the month, the government sought to reverse that out of requests from various stakeholders. That proposed reversal is on hold. The GRA has notified that that hold is to allow for stakeholder engagement. So we expect that as we go into the year, the GRA will come out with what the final position is, and government would announce its final position. So still to expect would be finality on the benchmark value policy that we have in Ghana. So as we speak, 50% on general goods and 30% on vehicle imports still applies, but this is subject to change depending on the outcome of stakeholder engagements and government policy direction in this regard. So these are other matters you should be considering. Now, we want to highlight some of the key tax risk areas to consider in 2022. We'll be calling on George to help give some insight on some of these. George, VAT is a high tax risk area, isn't it? And what are some of the key areas in terms of VAT that you are seeing in dealing with client issues and dealing with the government through the Ghana Revenue Authority?
All right, thank you, Wisdom. So when it comes to VAT, I would say that most often you see from audits that have been conducted by the GRA regarding VAT, and when it comes to the output tax, you see that it's more of issues around reconciliation of revenue. Financial statements revenue reported as against VAT revenue reported. And it's more of reconciliation issues. You see that because of the way businesses do keep records in terms of the outputs and in terms of what is actually constituting financial statements revenue, there are always issues. And I just want to touch on a few of the items that create some of these challenges. One has to do with where you are in the business where, for instance, you issue what we call free samples of goods. Free samples of goods or goods that are used for promotion of your business. This does not constitute financial statement revenue or income, but for VAT purposes, you are expected or you are required to report VAT on it. So at the end of each month, you are then supposed to, or for you to keep proper records, ensure that all the goods that you have used for free samples or for business promotions that you have done to promote your products, you keep a schedule to support your VAT returns that you have done. That does not mean you send that supporting document to the GRE, but you keep that on your file after you have filed the VAT returns. You keep it to support your output that you have reported. In the event of an audit, then you can show that. We have also seen issues around disposal of assets. Usually when certain assets are disposed of, we don't think about the fact that those disposals should be subjected to VAT. And so we don't charge it. Either you don't charge it, or where you have even charged it, it does not constitute financial statement revenue when revenue reconciliation is being done. You may have reported that in other income, or even when the disposal gives rise to a loss, it means that we wouldn't see it in income, but there's VAT implication on the actual sale that you did. And so it's important that you keep those records. We also see a lot of issues around export sales reporting into the VAT return, how this is kept. You see issues around reporting of VRPOs, issues around sales to entities within the free zone enclave. All these does not show on the output VAT as it were. You're either reporting as a relief item or exempt item because you are or zero rated item. And because you do not keep proper records of this, when they come in and they conduct the reconciliation between what you have filed at the VAT end and what you have filed per your financial statement revenue, then there are issues. So I think that it's important that you do monthly reconciliation. Why is the VAT reported for the month different from the financial statement? And then you'll be able to pick these things and then keep it on file. Mind you, within the finance sector, I mean, accountants, there's always movement. So you don't always have the same people remaining there all the time. And so if you move on, or if you take up a new role, you see that these challenges, you may not have the history of what has happened, but the only way to save the business is to ensure that these records are kept. Then we look at the input side. Input side, we also see during audits that businesses take input tax deduction a bit more late. The law requires that you have 6 months within which you are to take input tax. So when you receive an invoice, within 6 months, you should be able to take that invoice. The best thing is that when you receive the invoice this month, you put it either in this month or next month within. But what we have seen is that some businesses would wait until they make actual payments of the invoice before they capture the VAT. That poses a lot of risks. If your payment cycle, or because of funds, you are not able to pay on time and it takes over 6 months, then you end up losing that right for input tax deduction. I think it's important that businesses take note of the time between this and then keep schedules to help you to be able to ensure that you are taking the input tax deduction very well on timely basis. That is important. Then one area we have also seen has to do with VAT on imported services. This is even a significant issue for those within the financial sector, within the oil and gas sector, where they are not actually registered for VAT or they don't deal in taxable supply. In fact, until 2014, when the current VAT A70 became applicable, all businesses were doing VAT on imported services, where you had to file the imported service VAT on self-assessment basis, take the receipt, and then use it as inputs, and then claim it back. But with the introduction of A70, this changed. For those who are into taxable supply, if you are dealing in taxable supply and you receive an imported service or foreign services, it does not constitute imported service for VAT purposes. However, for those within the financial sector, oil and gas sector, and those who deal in exempt products generally, you are expected to then charge VAT on your imported service on self-assessment basis, and far same with the Ghana Revenue Authority. We see that this is a significant gap, or during audits that it comes up a lot that people do not necessarily comply, and we think that is something we should bring to the table. Then also we have issues around non-deductible inputs during tax audits. What we have seen is that businesses do take input tax deduction for some expenses that specifically have been stated that should not be taken, and because of awareness. And examples of such includes motor vehicles, expenses on motor vehicles. The VAT part of it, you are not required to take as inputs. Vehicle spare parts, you are not supposed to take as inputs unless And the key word is that unless you are in the business of supply or hiring of vehicles, then you can take the input tax related to such purchases or importation of such vehicles. There are, however, exceptions to this and under the law as well, that if it's a specialized vehicle that you have acquired purposely or solely for the purpose of the business, if it does not carry, if it carries, does not carry more than, doesn't have space to carry more than one person as a passenger, and then also the weight, I think you have about 12 or 13 tons weight, then those ones you'll be able to take the input because they are specialized. So, and then we have cases of ambulances and the rest, which have been specifically stated. So those exceptions are there. But apart from those exceptions, you are not entitled to take VAT input tax on motor vehicles unless you are into that business. If you buy a 4x4 vehicles, yes, 4x4 vehicle is purposely for business because you probably bought it for the CFO or CEO for the business. So it's solely for business. But the VAT part of it, you will not be able to take it. If you take it, it poses a risk to you. Then also around entertainment expenses, year-end parties, meals, lunches, hotel expenses, and what have you. All those expenses have been specifically provided that you are not entitled to take input tax on it. And so I think it's important that we are mindful of this so that it does not create significant exposures during tax audits. I think for VAT, these are the key issues that we should be watching out for in the year.
Great. Thank you, George. I believe so. With these ones covered, I'm sure if you are accounting for VAT, you should be doing a big part of your risks, and you should be doing a lot of good for your organization. It's interesting that when you use the example 4x4, it's always with the accountants you target, but for the CFO, 4x4 can be bought for the marketing manager too. Accountants under pressure everywhere. Thank you, George. Thank you for those insights. We still have some other tax areas that we can look at when it comes to general corporate income tax. Some of the points relate in terms of supporting documentation. One being for corporate income tax, supporting your expenditure. It's always an area of risk, and it's important, as George mentioned, that the filing, the documentation has the end in mind. The end would be the tax system is on a self-assessment basis. So whatever you are doing today, the mindset should be that you are going to account for it, not in an enthusiastic manner, but then you are accounting for it to the Ghana Revenue Authority in some years to come. So what is the documentation you are putting in place to justify the position that you are taking? Also accounting for tax losses and tracking the tax losses and financial cost restriction. An area of risks we are seeing if you are in general business 3 years, if you are in the specialized areas such as manufacturing, mining, petroleum, power production, and all that, you fall within the 5-year category. So it's important we are tracking and accounting for tax losses in the appropriate way. And then determining think cap on shareholder debts. It's important in the market we find ourselves. The think cap restriction relates to both interest and foreign exchange losses on foreign shareholder debts, or if it's a local shareholder and the shareholder is exempt, then that debt would fall within think cap if your debt to equity ratio exceeds 3:1. So it's important that is an area of consistent review on a quarterly basis, because you do not want to fall outside the 10% margin of error for a provisional corporate tax payments. And then on an annual basis, when finalizing your tax calculation for the year, and then under provision of CIT also becomes a high risk area, because at the start you may not be seeing the provisioning or the outlook in the best way. The first quarter filing is very limiting because you've seen only 3 months of the year. It's important that the third and the final quarter filing for provisional corporate tax is taken as a critical activity, and you do the determination in a way that you are as close as possible to the reality for the year. We'll look at some other risk areas from a personal income tax point of view. I'll call Lovejoy to tell us. Lovejoy, what have you been seeing from a personal income tax point of view? What are some of the risk areas that our clients and the general investing public should be paying attention to?
So much wisdom. So I think it's important to mention the underlying principle of employment taxation. So employment taxation is basically the profit, whether in kind or in cash, received as a result of employment relationship with an employer. And unless otherwise specifically stated in the law as exempted, or the employer has secured a dispensation or ruling for its exemption, none of the income should not be taxed. It has to all be consolidated and taxed accordingly. In our involvement with the GRA on several audits, we have realized some few items that employers are omitting to tax and to extra penalties and interest. Some of these items are the likes of school fees, flight tickets, vacation benefits, gifts like company products, Christmas vouchers, and Easter vouchers. So because these items are usually done outside of payroll, employers are usually not taxing this element. The ideal situation is that at the point of making payments to the individuals, it is reported and taxed. Notwithstanding, we are admonishing that if this does not happen at the point of making this benefit, at the end of the year, you should make sure that by the December payroll calculation, where you are closing up on all your employment taxation before the 15th of January, all these items should be specifically captured in the tax calculation. For gifts, what will be required will be the market value of the gifts that you gave out. So if it's a package that you gave to the individual, you need to consider the market value of the package and consider it as an additional benefit in tax. Another interesting area is with respect to expatriate remuneration. And the GRA has been alarmed to this remuneration, and it's coming up in audit. The employer's contribution towards pension, which is not registered in Ghana. So the foreign pension contribution, we have expatriates coming into the country who are usually still maintained on their home country pension scheme. So there is a benefit in here. The employer portion that is going to this scheme is a benefit to the employee. But because there is no provision under the law or a dispensation for its exemption, it has to be added as an income and taxed accordingly. Another interesting subject is the end of service benefits or long-term service awards that are given to employees who have served an employer for a long time. So it's worth mentioning that this item has no specific provision under the law. So the use of flat rates like the 5%, 7.5% would not be applicable. So far as there is a relationship between the receiver and the giver, and it is an employment relationship, it's worth noting that there is no special treatment like the bonus and the overtime. It has to be added to the assessable income of the individual and taxed at the graduated rate, that is for a resident individual. And it's interesting also to note that 9 duty allowance, as it used to be under Act 596, employers are still treating it as such. So under Act 592, what the provision was is if a 9 duty employer satisfies the condition of being recognized as a 9 duty employee, And also, if the amount allowance does not go beyond 50% of a person's basic salary, then that income is exempted from tax. We wish to emphasize that that provision is not all. There is no specific provision for non-duty allowance anymore. And so as such, non-duty allowance going forward is considered like a cash allowance, which has to be added to the assessable income of the individual and taxed accordingly. With areas of pension, what we've realized is Social Security has increased the compliance reviews that they do. Unlike before, where you would be, an employer will not have officers visiting them for this compliance review. Now it's much often. And they require that all employees on your payroll file register and pay Social Security. But because of the National Pensions Regulatory Authority's guideline and ruling on exempting a set of expatriates, there is a concern that we have realized with respect to the contract duration of these individuals. Contract letter or assignment letter is a supporting document for the issuance of a pension exemption. And the condition for securing this exemption is two. The first one relates to the duration of stay in the country, and if you are able to prove evidence of being on a similar scheme outside. When it comes to the duration of stay, the first point of contact that the authorities will be satisfied is the contract letter or the assignment letter. So where the contract letter or assignment letter states something beyond the 3 years they have provided, then the contract letter will not suffice for the issuance of the exemption. What we've realized in the past is employers have the intention of keeping expatriate for, let's say, years, but will still issue an open-ended contract. And it becomes very difficult to get the authorities to issue an exemption. So we admonish that if the duration of stay is known from the start of assignment, then employers should avoid issuing an open-ended contract, but rather state the duration clearly on the contract, and they will be able to secure pension exemption, and compliance will be smooth with the authorities as well. So these are some of the few things we have identified when it comes to personal income taxation.
Right, Lovejoy, thank you. So I think just to emphasize that the non-duty allowance taxation died with Act 592 in 2015. So with the Act 896 coming into force from 2016, non-duty allowance is no longer exempt. So this has to be re-emphasized because we are still seeing some entities treating non-duty allowance as exempt. Right. Great. Okay, so thank you. Again, we will go to the ubiquitous transfer pricing. Eric, you must be having a hard time with transfer pricing this year. What should we be looking out for from a transfer pricing point of view? Again, timelines for filing, the updated TP return, transfer pricing audits, documentation. What can you tell us from that space?
Yeah, thank you very much, Wisdom, once again. So I think the major thing around transfer pricing this year is that you could clearly say the timelines. For local file master files, with most jurisdictions and most companies or multinational entities, it takes time for them to complete it. But around June, that means you have only 6 months to have these documents being prepared. And we believe that most accountants will be concentrated on the main statutory audits and filing of the CIT returns, and may give little or no attention to these aspects, which may then be a possible afterthoughts that may come in. So what we advise is that we should try and go hand in hand when the main audits are being done, and when the CIT preparations are being done. We're also taking cognizance of the local file master file preparations. Also, in terms of the updated TP return, there are requirements around attaching copies of your consolidated financial statements. We know that is a clear bottleneck because most group financial statements may not be ready, even if we apply for the same extension of time up to the end of June. For that reason, we also feel that taxpayers should have that at the back of their mind, have discussions with the group and see how best to engage both their internal team and the Revenue Authority on these bottlenecks that may exist. One key area that we've noticed that has been going on for some time, and even with prior years, it's tax audits. Now, transfer pricing audits has a peculiar way of going about, where in recent times, we've noticed the Revenue Authority extending the main statutory audits for direct and indirect taxes to transfer pricing. What I mean is that when a normal direct and indirect tax is completed, once there are related party transactions therein and the pricing around those related party transactions are provided, they are looking to delve deeper, and the transfer pricing unit, which has fully been equipped and enhanced by the Revenue Authority in recent times, would come in there to analyze these transactions and confirm saying whether the transfer pricing or the prices that has been charged for the related party transactions at arm's length. What we've also noticed is that with the additional filing requirements of the local file and master file, the transfer pricing unit will be more equipped and have enough information to even proceed with tax audits before coming on the field for additional information. So these are key areas we expect that in the coming years going to be key discussion points that will come up. Now, one of the major things, and I think from George's presentation, from Wisdom's presentation, is documentation. And it's a key area that we've had with transfer pricing. Most companies do not have the basis on where the prices were charged, the basis on where the cost was applied or the markup was applied on that cost, what schedules they have, invoices, emails, reports, travel documents, hotel, which always form the crust of the cost on which these markups are applied on. And if it's a key area that the Revenue Authority look to disallow these transactions, because once we're able to provide evidence, one of the key criterion within the regulation, both the XWAL transfer price regulation and the current mentions that there's a need for you to show evidence that the transaction truly did take place. And what better way to show the evidence than showing the proof that emails, correspondence, and reports have been shared on the service in terms of management service, technical service that has been provided over the period. So these are the key areas in terms of summary that we should be looking out for the year.
Right. So again, that's a lot. So in maybe what are the two key related party transactions that we should be looking at from a TP risk point of view? What are the two transactions that if you are having for a related party, the tax authority is more than likely to be looking into?
Okay, I think the two major ones are mostly the technical and management fees that are charged and possibly interest on intercompany loans or shareholder loans. Now, what we've noticed is that most multinational companies, their main concentration is registration with the GIPC and the remittance of the funds being undertaken out. And obviously, GIPC provides specific rates within the technical and within the TTA agreement, the technology transfer agreement, that provides specific rates that should be applied. But the GIPC and the Revenue Authority have no link, for which reason a benchmark analysis will be performed to ascertain whether the transactions are being undertaken under the transfer price or related party transactions with the Revenue Authority at arm's length. So that gap is always an issue that always comes up when we're having deliberations for clients. Then obviously, interest rates that be applied on intercompany loans, most intercompany loans, when their interest being applied, tin cap is not being considered. The rates that is applicable on those particular intercompany rates are not being delved deeper to ascertain that whichever rates are being charged at arm's length and those other aspects in terms of agreements being in place covering these transactions. So those are in terms of a nutshell what is in the market now.
Right. So management and technical services and interest on intercompany loans. Thank you for those insights. We may have some questions from a transfer pricing point of view, and we'll look to do that. So the last section, of course, last before you have your time, is what should be on your desktop. What should be the calendar you have on your desktop? If you're a CFO, if you're a tax manager, if you're someone accounting for tax compliance for your organization, this is what you need to have on your desktop. So the tax calendar for the year 2022. So it's a summarized one. We have your regular monthly PAYE payments due 15th of the next month, following the month to which the payment relates. If 15th is a Saturday, for instance, you pay the last working day before that deadline. The same for monthly PAYE, and pension contribution should be paid by the 14th of the following month. We also have the monthly VAT. It's important to emphasize that monthly VAT is at the end of the following month. So for January, the filing will be end of February. We have CST, which is also end of the following month. But if you have to pay VAT on imported service, so VAT and levies on imported service, then that is the 21st of the month that follows. So if you have to pay VAT on imported service accrued or paid in January, then by 21st of February, you should be filing the return and paying that to the Ghana Revenue Authority. So that is very critical. Again, another important date you should not miss is 31st March, and this is for companies that have the calendar year as the accounting year. So if you have a January to December accounting year, then by 31st March, your first quarter comes to an end, and you would need to file your provisional assessment for the year 2022. So that is something we should take note of. At the end of April, a lot is happening. So end of April, we have the employer annual deduction schedule due, individual personal income tax returns due, corporate annual corporate income tax return, unless you have an extension, 2-month extension that takes you to June, end of June. And then we have the transfer pricing return due end of April. Again, if you have an extension, end of June will then be when you file. It's important to take note again that this year's transfer pricing return filing for the year 2021 would mean that you are filing an annual return, a local file, simply referred to as the transfer pricing report, that documents the transaction, the benchmark analysis, industry and functional analysis. You are filing that, as well as the group master file for 2021 by end of April or June, if you have an extension from the Ghana Revenue Authority. We also have 30th June, you cannot miss. Tax amnesty is ending 30th June. With this extension, you cannot miss tax amnesty for this year. So again, 30th June, we should take note of 30th June. We have self-assessment for second quarter. The other critical one for me is the last quarter for 2022. And again, this is for entities that have the calendar year as their accounting year. So if you have the calendar year as your accounting year, the last quarter filing, as I mentioned earlier, it's important that you review your CIT provisional calculation and make sure that you are not falling outside the 10% margin of error. You are as close as possible to your provisional, to your actual tax liability for 2022, as you would with your provisional assessment. Now the big man comes in, country by country reporting for the first time in Ghana would be due 31st December 2022. Now this is something that you need to talk to your consultants on transfer pricing, but essentially this is a filing that has to be done with the Ghana Revenue Authority. Provisions have been made to file this country by country reporting, and of course there are some exemptions that could apply. So this should be your calendar. Again, we are going to share this after the presentation so that you can have this on your desktop and be able to refer to this anytime you have to check when next you have a compliance obligation. So this would be where we now go to take your questions. I'm mindful that a number of your questions in the chat box have been answered live, but then we would allow those who raised their hands to ask the question. So I see Kushal. Kushal, your hand is up. So my producers, can you allow Kushal to speak? Kushal, I'm sure you can unmute now and speak. And then we will take 2 more from the live call, and then we go to the chat box again to check what questions we have. Kushal, if you can hear me, please. Hello, Kushal. Okay, so maybe Kushal may be getting ready. I see. Kushal, are you ready now? Hello, Kushal. Sorry, your connection is not great. Maybe you may want to reposition, and then we call you, or you can put your question in the chat box. So, Mr. Kumi, happy to have you. Let's hear you, please. Isaac Kumi. You are unmuted now, so you can speak. Okay, sorry, maybe Isaac's connection. Bright Ofori, can we hear you, please? Okay, so yeah, hello. Okay, so we can take Bright. Bright, can we take you, please?
Hello.
Hello, I can hear you.
Good morning. I'm Bright Ofori from Tema.
All right. Can we hear your question briefly?
Okay. Yes, sir. Thank you for this wonderful opportunity. And my question is an observation, whether it's an error or something. The PAYE table you display.
Okay.
Next after 36,000. Next after 36,000.
Okay.
There is a circular I saw that was 196740. But when you display yours, it's a little bit different from what I saw in circulation. So I wanted a confirmation.
Okay, right. We'll confirm that for you. We have your email, so when we share the slide, you see the confirmation, please.
Thank you.
Right. Okay.
Wisdom,
thank you. So
Kusha has mentioned that his hand was up in error. I just spoke with him. So.
Okay, right. That's fine. Thank you. So I would just want to take one more. So Joseph Bento, and then we'll want to go to the chat box.
Hello?
So we'll go to the chat box. I clearly see the struggle that radio presenters go through to have live calls in. So we'll go to the chat box. So if you don't mind, kindly put your questions in the chat box. George, I know you've answered a number of questions in the chat. Yeah. Are there any that we should be looking at?
Yeah, so I think what we have not looked at is from Enoch. Enoch is asking that we speak a bit on the 200,000 threshold below which TP return is not required or not compulsory. So, yes, Eric, you can answer that.
Eric, please take that.
Okay, thank you very much, Wisdom. So the regulation says that if you have a related party transaction, that the value of that transaction for a year of assessment that's going to exceed 200,000 United States dollars, the CD equivalent of it, then you're not required to put up a documentation. You're also not required to notify the Commissioner General about it. I believe come year and your financial statement and the breakdown of related party transaction for that year would satisfy any review the Revenue Authority will be looking to do during an audit. So that's the in terms of the mandate around the 200,000. Also do note that where there's a possibility of you attempting to aggregate transactions, so let's say a management fee, a technical fee being merged, the Commissioner General has the right to separate them and treat them as independent transactions. So that's also in terms of updates on that side. Thank you, George.
Okay. All right. So wisdom, the other one has to do with, I think from an anonymous person, I can't see the name, but it has to do with project cost. Whether both the project cost and which is made up of direct cost and agency fee should be subjected to VAT. So I think I can take that one. Yeah, so unless a specific project has been granted exemption, it's expected that the entire project would be subjected to VAT, and then you also be able to deduct any cost you incur as input tax, unless there are exemptions provided. So there will be a significant risk if you apply VAT only on the commission, because the direct cost part is expected that will go into your input tax deduction and your cost as well, whilst the entire project that you are going to bill to your customer would be at the revenue side, and so the VAT is applied on sale. Like I said, unless the project has been granted exemption.
Right. Thank you, Jay. Thank you, George. So, Lovejoy, there was a question on end of service benefits. I don't know whether you saw it, and then there's another on how to treat reimbursement amounts with regards to tax. Can you take that?
Okay, so with regards to the end of service benefit, if I understand correctly, the individual is asking if the contributions that they are making towards PF, which they are terming as the end of service benefits at the end of the day, should be exempted. So there are two conditions to consider here. The first one is to consider if the PF is going to a registered scheme. A registered scheme means that a registered entity under the MPRA. And the second aspect of it is if the amount of contribution going to this fund does not exceed 16.5% of the person's basic salary. 16.5% means both the employer and the employee's contribution. So if it does not exceed 16.5%, then it's an exempt income. But if it goes beyond 16.5%, what we'll do is we'll cap the exemption to 16.5, and the excess amount will be taxed in the hands of the employee.
Okay, right. Thank you for that. Then there is a question on reimbursement. Maybe you can touch briefly on the general position of the law in terms of reimbursement.
Okay, so when it comes to reimbursement of cost, what's understood is that the item that you are being reimbursed for should, first of all, be a cost that you have incurred as a result of rendering a service on behalf of the business. And that action satisfies the business purpose, or it is in line with the business purpose. Once that is ascertained, then the reimbursement amount will not be taxable in the hands of the employee. But where the reimbursement is falling outside of a transaction made on behalf of the employer, but towards domestic expenditure of the individual or direct benefit that has not been specifically stated under the law, then these reimbursements are taxable in the hands of the employee. With respect to reimbursements, we've seen nature like medical, and clearly there is a provision in the law that covers medical reimbursement. So if that is available to all employees, considering the levels at stake, then such a reimbursement is exempted from taxation. So going back to the underlying principle, at every point in time, when a benefit is being given out, we would have to check if there is a special treatment under the law for this payment that is going out. If there is no special treatment mentioned under the law or a ruling or a dispensation, it will mean that there is no room for exempting such income.
All right, Lovejoy, thank you. I know there are a few more, but we want to close on time. Let me quickly touch on a few that we can look at. So Someone asked on the taxation for property owners in Ghana. So if you're a property owner, it depends. If you're an individual, you may be falling under a final withholding tax. So 15% on the payment to you, and that could be final unless it is in the course of a business. So if you are an individual but you are running a business of having buildings and letting out, then the withholding tax would not be final on you. Again, if it's a building you are letting out and it's not one for accommodation, but it's a commercial building, then you should be looking at the threshold. If you meet the VAT registration threshold of 200,000 in a 12-month period, then you would be required to register for VAT and charge VAT on letting out of commercial space. Now, Farid also asked foreign invoice with VAT. Yeah, so if you have a foreign invoice with VAT, you have to inquire from the one who is giving the invoice whether that is the law. If it is the law in that person's country, then you have no choice than to pay. But that VAT will not be VAT that you can claim input VAT for in Ghana. That becomes a cost to the business in Ghana. So yes, it's possible you can receive invoice from outside Ghana that has VAT on, but then if you confirm that the supplier does not qualify as zero rated and there should still be VAT, then you would have to pay the VAT and it becomes a cost to your business. So update on withholding tax rates in relation to contracts, services, and goods. So there have been no changes. Withholding tax, at least for the local space, are 3%, 5%, and 7.5%. 3% for goods, 5% for service for works, and 7.5% on services. Foreign, I see there was a question around non-resident service fee. The general rate is 20% for non-residents. If your counterparty is in a double tax treaty country, then it's likely to reduce to 8% or 10%, depending on that country and depending on whether the person qualifies as the beneficial owner of the payments. So we still have a few more, but please see feedback form has been, feedback link has been set in the chat. We would want to take all your questions, but unfortunately time would not permit. We would want to wrap up at this point, and thank you for making it to our tax outlook for 2022. I hope this past minutes, 1.5 hours approximately, has been worthwhile. We would share the summarized version of the slide with you and the recording once it becomes available. Please keep in touch, and best of the day and the weekend to you. Please take a few minutes to log on to our feedback link and let's hear from you. We'll take the questions that are unanswered and we'll get back to you individually if your question has not been answered in this discussion. We also would want you to look out for our trainings that are coming up. Our next training is on the 24th of February on transfer pricing. The year is a transfer pricing year. 24th of February, we will publish that and we'll send you the flyer for you to see the details. 24th February, transfer pricing, a deep dive into transfer pricing and related matters. Have a good one for the day and a fantastic weekend to you all. Thank you very much.
Thank you, Wisdom. Like you said, Lovejoy. So Frederick, Lovejoy is responding to your question. I've seen your question. Lovejoy is addressing that in the chat box. Yes, but you can always reach Lovejoy as well to give you direct response to that.